Hello, dear friends. My name is CT. Stay with me because something important is unfolding in the silver market right now. Not weeks from now, not someday later, but right now. Over the last hours, we've seen sharp moves, unusual behavior in spreads, and a clear shift in tone across the metals world. The paper side of silver is showing stress, while the physical side is getting louder. These moments don't appear randomly. They show up when confidence starts to crack and participants quietly wonder whether there is enough real metal behind all the paper promises. Here on Currency Theory, we focus on those signals before they turn into headlines. Before we go further, a quick request. Many of you watch these updates but haven't subscribed yet. If you find value here, hit the like button, subscribe to Currency Theory, and leave a short comment. That small action helps this channel survive against recycled content. Now let's talk about the rumor spreading fast. Some large silver producers may be diverting output away from traditional paper exchanges. I can't confirm this, and I'm not asking you to accept it as fact, but even partial truth would matter. Paper exchanges rely on steady inflows and trust in delivery. When that trust weakens, pressure builds quickly. What triggered the current urgency was a sharp event on a major Asian silver futures exchange. Several accounts were accused of breaching limits, and the exchange publicly imposed restrictions. That tells us the move wasn't normal trading. When exchanges step in openly, it's a sign of stress, leverage, and crowding. Large amounts of synthetic silver can be created instantly through contracts, but that supply doesn't come from mines or refineries. It comes from leverage, and leverage only works while confidence holds. This brings us to the key question. Are we closer to a real silver squeeze than we've been in years? Possibly, not because of one rumor, but because several pressure points are overlapping. On the US futures market, the most important number isn't price, it's registered inventory, the silver actually available for delivery. Eligible metal exists too, but it belongs to someone else and isn't guaranteed. When open interest represents massive paper claims and registered inventory remains limited, even a small increase in delivery demand tightens the system fast. In calm markets, most traders roll or settle financially, but when trust erodes, more participants consider delivery. Registered inventory has been trending lower, and while it can move day to day, direction matters as delivery months approach. At the same time, physical markets in Asia continue to command premiums. Those premiums may narrow at times, but they haven't disappeared. When the East prices metal higher, it usually pulls Western prices upward. We've also seen moments where Western markets flirt with backwardation when spot trades above futures. In silver, that's a warning sign. It suggests urgency and preference for immediate delivery over future promises. Physical dealers are reporting mixed conditions. Some are overwhelmed, others are rationing product, and physical spreads have widened sharply. Uneven flow doesn't guarantee a squeeze, but it often appears before major moves. The squeeze discussion becomes serious when large short positions exist alongside tightening supply. If shorts can roll or settle in cash, they survive. If buyers demand metal and supply is scarce, price becomes the pressure valve. At the same time, reports continue of wealthy buyers accumulating physical silver quietly. Silver isn't just an investment metal, it's a critical industrial input used in electronics, solar energy, defense, and medical applications. When industry fears shortages, it secures supply regardless of price, and that behavior can shift markets quickly. The paper-to-physical ratio remains the core vulnerability. Paper claims still dwarf deliverable metal. Most days that's fine, because people trade exposure, not ounces. But when fear enters the system, people want certainty, and certainty means real metal. Margin hikes and circuit breakers can slow volatility, but they can't create silver. They delay pressure, they don't remove it. Gold also feeds sentiment. Ongoing questions around reserves, audits, and repatriation weaken trust in paper claims overall. When trust fades, silver often reacts more violently because it's a smaller and tighter market. So what should you do? First, don't trade on emotion. Volatility is designed to shake out weak hands. Second, understand what you own. Paper products are not the same as physical metal. Third, watch the right signals. Watch registered inventory trends, delivery behavior, regional premiums, and curve structure. As the next delivery window approaches, the story could either cool down or intensify. If inventories keep thinning and delivery demand rises, the paper system will be tested. If stress fades, that's useful information too. Either way, stay calm, stay informed, and stay prepared. If you support original analysis, make sure to like this video, subscribe to Currency Theory, and leave a comment telling me which signal you're watching most closely. My name is CT. Thanks for watching, and I'll see you in the next update.